Hello, everyone. Welcome. I'm Nichola James, and I'm here today with Thomas Torgerson. We're both the co-heads of Global Ratings for DBRS Morningstar. And today we're going to talk to you a little bit about our update to the 2022 outlook for global sovereign ratings. We have our first slide. Tom, I think, with the agenda. Okay, so I'm going to start with an introduction and talk a little bit about our outlook for sovereign ratings, also looking at the rating actions that we took during the start of the pandemic up until the current position. Then we've highlighted three of the key risks. Obviously, today, everybody is focused on the Russia-Ukraine situation, so we've brought that to the top of the agenda. I'll talk a little bit about geopolitics. Then Tom will come in and talk a bit more about the COVID-19 pandemic, how we see that panning out, and also inflation and interest rate responses that are obviously critical for economies and for markets. And then we'll have a Q&A, so at that time, please put your questions into the chat. Okay, so to start, by way of an introduction, there should be a chart there. And see Tom, the chart on. That's it. Perfect. Okay, so the economic recovery is ongoing, as this chart shows. Relative to 2019, where we were seeing growth rates in advanced countries that we kind of got used to for many years, that growth came to an abrupt stop, as everybody's aware. The countries and regions were shown on this chart went into an abrupt stoppage and economic contraction. And already by next year, we've seen that some country groups and some countries like the US and Canada had mostly recovered, and the US's case exceeded its pre-2019 output level. And in other countries started to make up for the lost ground. In the Euro system, mostly recovering, but most EU countries are unlikely to reach their pre-2019 levels of output actually until the end of the year. The end of the year should complete the recovery for each individual country. Japan has also seen recovery, but the recovery there will continue over a number of years, be a little bit more extended. So in terms of the narrative, as 2022 is well underway, the course of the pandemic, of course, continues to determine the economic and fiscal outlook. And despite some weaker data that we've seen in December and January, growth appears to be accelerating as we move towards the second quarter. While, of course, the risk exists of a more dangerous virus variant, it's also possible that, like Omicron, future variants will be less harmful to health. And also in conjunction, of course, with vaccinating populations and antiviral advancements, it is possible that while the reminder of Omicron variant was that the pandemic continues, it may be that there maybe could be less severe effects going forward. And the risks that we pointed to in our February 2021 outlook haven't yet materialized. The baseline outlook for sovereign credit ratings is relatively positive. So that said, the strengths of the recovery that we see in that chart are really coming from the extraordinary stimulus that's underpinning pent-up demand and still targeted government support, strong household balance sheets and high levels of liquid savings in advanced countries. And the risks that we flagged in our 2021 outlook relating to increasing trade and investment barriers haven't fully materialized, but are now intensifying in the wake of Russia's recognition of Ukraine's breakaway regions and its military operations in Ukraine that commenced this morning. So in terms of COVID, we continue to monitor risks of more harmful COVID variants and the impact of government policy responses. Emerging inflationary pressures and central bank tightening may weigh on real growth, and this could pose additional challenges to highly leveraged household firms and governments, and Tom's going to talk about that as our third risk that we're observing a little bit later on. Okay, so the next exhibit shows the sovereign rating actions that we took since the start of the pandemic. I'm going to say a little bit about the outlook as well. So this chart shows clearly that the majority of our ratings during the pandemic have been confirmed. And since then, a small number of upgrades have occurred, and these have been in Europe, while Asia and the Americas have seen one downgrade each. And representing the ongoing recovery and progress in containing the impacts of COVID, and in terms of the limited number of rating changes, stable to positive has been the most commonly occurring rating action recently, and there have been no changes from stable trends to negative trends. So this year, we're likely to see some rating actions as we resolve some of the trends that are currently in place. And of course, new country-specific developments can also affect ratings. However, our current projection points to stability in most of our quantitative assessments, underpinning our sovereign ratings, our scorecards that we publish, including some of the cyclical indicators such as fiscal balance and debt. And in terms of broad macroeconomic trends, they're likely to be favourable for most of our rated sovereigns, particularly in Europe, where continued recoveries can allow returns to fiscal improvement paths underway before the pandemic. So turning now to the military action in the Ukraine and the implications on the ratings. At present today, the military action in Ukraine is unlikely to have immediate rating implications for our public sovereign ratings. However, through various channels, we could see consequences and are likely to see consequences for some economies, particularly in Eastern Europe, and ultimately these implications could contribute to downward pressure on some ratings in the future. So the channels that we're looking for are varied, and these include market reaction, energy prices and inflation, a potential massive outflow of refugees from the Ukraine, and sanctions, counter-sanctions, especially those that involve reductions in Russian oil and gas supply or any implications or disruptions to Russian oil supply from other ways. And in terms of other regions, we see the macroeconomic outlook as less favourable than Western Europe in Latin America. Although our rated sovereigns in Latin America have largely recovered from the pandemic downturn and most trends are stable, weak potential growth and fragile public finances are key concerns. In addition, other uncertainties have emerged which could dampen the outlook for ratings in all three major regions, and we'll be observing those. So now we're going to talk a little bit about the first risk, the one on everyone's mind today, the geopolitical risk of Russia's military action in Ukraine and other geopolitical risks. So let me see. So the chart, yes, this chart, fine. Okay, so I'm going to refer to that chart, but by means of background, geopolitical risks and sovereign ratings, geopolitical risk can affect economic outcomes of specific countries or many countries, depending on factors such as whether or not the geopolitical risk can be contained, or if the event becomes protracted, and the type of shock that's subsequently generated, including, not least, human impact, commodity prices, supply shocks, and financial market reactions. So the geopolitical risk can have very material implications on sovereign ratings. And for several years, we've been watching three major sources of global geopolitical risk. We've published commentaries referring to these risks. For example, China's evolving relationship with the US and its other Asian neighbors, Russia's relations with NATO countries, and the various security, religious, and social tensions in the Middle East. Our concerns expressed in our last outlook in February 2021 regarding rising protectionism were largely a reflection of our assessment that changing dynamics in those relationships could spark increased protectionism and do additional harm to global trade and investment flows. And Russia's ongoing actions in the Ukraine today raise a host of other concerns in addition to the implications of economic sanctions and counter-sanctions. So this particular conflict poses the greatest potential risk to European stability, as everyone's aware, and to energy security, especially in Europe and in those countries most dependent on Russian energy. So damage to pipeline infrastructure or the international cut-off of Russian gas supplies to Ukraine could impose immediate economic and social costs, especially for countries receiving gas through the Ukraine pipeline. The prospects of severe cost to human life, infrastructure, economies, financial systems are extremely troubling. We do expect that Russia's actions will foster over the longer term, though, greater alignment between the EU, the UK and the US in energy policy and other security policies, and could over the medium term increase investments into an alternative energy supply and the diversification of energy sources in Europe. So this chart shows the share of oil and gas imports from Russia in total countries' national oil and gas imports for a range of European countries. The variation in the European reliance on Russian energy highlights the difficulties Europe has faced in recent days in discussing and agreeing and constructing a single option on the approach to sanctions on Russia. But given Russia's latest actions, appears to be some willingness to foster some more common ground. So this chart, the overall way to look at it is that the countries in the top right-hand quadrant are the most dependent on Russian oil and gas in their imports of oil and gas, and the countries in the the top right-hand quadrant and in the bottom left-hand quadrant are the least, although that is a vast generalization because most countries on this chart are dependent to some extent, and some countries are highly dependent, including those countries in the central area of the chart, including Germany and Italy. We can talk more about that in the Q&A if there are more questions. The second chart on geopolitics and vulnerability to the current crisis is the map. And this map shows our construction of a gas vulnerability index. In the calculation of this index, we consider national gas production, consumption, gas usage in energy consumption, and Russia's share in total gas imports. So you can see from this map the most strongly coloured countries: Hungary, the very dark blue, Hungary, Latvia, followed by Slovakia and Lithuania, but also countries such as Germany and Italy and Austria are highly dependent. And we've previously written a commentary entitled Politicization of Energy Risk in Russia-Ukraine Conflict, which you may like to refer to and you may find helpful. So just to finish off this side of geopolitical risk, and obviously there's many questions here that we've not touched on yet, we can talk about later, but just also to say in the wider context of US foreign policy, President Biden has adopted, as you will be aware, a more cooperative approach in foreign and trade policy with China and Europe than his predecessors. However, tariffs are still in place, and this is creating frictions and obstacles in international trade. And as I mentioned, Europe has struggled to speak with a common voice, and this is complicated by UK's departure from the EU. And just to emphasize again, the geopolitical risks are critically important. And while focus is now on the Russia-Ukraine situation, we are mindful of the risk of the potential for risk escalation also in Asia and also the Middle East, even in the midst of the Ukraine crisis. So we can pick up geopolitics more a little bit later. So Tom, I'm going to hand over to you now to talk about the pandemic and the inflation and interest rate response.
Thanks a lot, Nichola. Appreciate it. The Ukraine situation that Nichola has reviewed obviously will dominate a lot of attention in coming weeks and months, but we wanted to spend a little time discussing some of the other challenges that we see, starting with the pandemic. The latest data on the Omicron variant, we have found somewhat reassuring. On the one hand, it has spread very rapidly, even amongst highly vaccinated populations, and the caseloads are likely undercounted in many regions where testing remains voluntary, and particularly where testing facilities have been overwhelmed. On the other hand, the hospitalization rates have remained relatively subdued, particularly in countries and regions where vaccination rates are highest. We've been watching this data for several months now, and the visible downward trend line has been persistent through the Omicron outbreaks, meaning the countries that have progressed the most in delivering vaccinations have generally seen lower hospitalization rates amongst their populations. All sorts of caveats with the data, but again, that has been a persistent trend over the last several months. And in December and January, we saw many governments tightening travel restrictions and strengthening other countermeasures in response to Omicron. Some in Asia are still on that path even now. But the countries that have enacted those measures, those have been generally limited in its scope. And many countries are already in the process of removing those measures and easing other restrictions as well. There's a growing list of countries that appear to have concluded that a strategy of simply living with COVID is now the optimal policy choice. As vaccines are widely available, health outcomes are becoming less severe, and a growing segment of the population has had experience with the virus. Ultimately, the measures necessary to completely prevent the spread of this latest variant are also viewed as unsustainable over any considerable period of time. Now, that doesn't mean one can declare victory, or if that even can be called a victory. We hope, of course, that future variants will be relatively benign, but we're not all that assured that COVID will not take another turn for the worse. Any new variants that evade immune protections would ultimately strike fear into a large number of households in a large number of countries. That could again stress medical care providers and would likely present a major setback for the global recovery. In this uncertain environment, government policy responses are also leading to open debates, increased discontent, social pressures. And it brings us to the main point we've made about this pandemic for some time now, that the debts always come due, and we don't think the effects and after effects of the pandemic can be fully tallied just yet. And we'll continue to watch for additional signs of political, economic, and financial stresses. Now, one of these after effects is inflation and the prospect of rising interest rates. The forceful government responses to the pandemic have combined with rising house prices and other rising asset prices, which left aggregate household balance sheets in excellent condition across the major economies. The composition of demand has changed, meanwhile, favoring goods over services, while periodic work stoppages and other production challenges have constrained any supply response. Labor markets have tightened as well, though total employment remains below pre-pandemic levels in a few countries, particularly the United States, which remains down about 2.3 million jobs from a pre-pandemic employment. In that context, the inflationary pressures really have broadened beyond food and energy prices, particularly in the UK and the US. We put together just a quick visual to help explain that the divergence in economic recoveries, as well as the inflationary pressures that have emerged most acutely in the US and other countries. This chart shows real income of US households from two sources: wages and also transfer receipts from government payments. That black line on top with the jagged peaks represents the US response, and those peaks represent the transfer of US stimulus payments to households. By way of comparison, we've included the dashed black line, which shows the average from 5 different recessions between 1970 and the early 2000s, and the dotted line, which shows the global financial crisis. Clearly, the developments in US household incomes has been starkly different from any past recession over the last 40 and 50 years. So that helps explain some of the, again, the strength of the US recovery on the one hand, but also some of the emerging inflationary pressures that the US has faced. When you compare other countries, Canada, for example, also had a strong response, also I think stands out historically, but not quite as strong as the United States. Then the UK follows shortly after that, with most of that increase coming through wage growth. And then you have France and other continental European countries where the wage response has been actually quite limited thus far, and therefore the recovery has been slower, and the overall impact in inflation has also been more gradual. It's important to emphasize that from a credit standpoint, a short-lived burst of inflation is not necessarily bad for sovereign credit risk, particularly when driven partially by supply constraints. We've just come through a prolonged period of ultra-low inflation in the major advanced economies. The immediate consequences of rising global inflation are generally positive for sovereign credit risk and reduce the real burden of outstanding debt. Meanwhile, increased housing values also provide increased protection against widespread debt defaults as home equity increases for current owners. Those higher prices, as those unfold, will obviously reduce real disposable incomes and slow the pace of economic growth. But to the extent that the recent burst of inflation moderates and inflation expectations remain well anchored to central bank targets, without a need for highly aggressive and sustained interest rate hikes, we would expect the medium-term impact to be relatively benign. Now, additional shocks to inflation are precisely what we're worried about, particularly in the context of the geopolitical and pandemic risks we've already discussed. Those could perpetuate price pressures and ultimately have a substantial impact on expectations. We see here that there has already been a marked shift in expected inflation for 2022 in response to the last year's surge in inflation, especially in the US, again, in Germany and the UK, the Euro area as well. With limited slack in labor markets, rising wage pressures, and excess savings built up during the pandemic, we think strong demand could continue to bid up the price of labor and goods. And on the other hand, survey-based and market-based expectations for medium-term inflation remain closer to central bank targets, in most countries in the range of 2 to 3% over the next 5 years. And that compares favorably to for the US, nearly 5% expected inflation in 2022 and nearly 6% in the UK. Faced with sustained price pressures, this could lead to substantial shifts in interest rates, though I would note likely not before 2023, as central banks seek to bring expectations back in line with inflation targets. If such actions become necessary, this would clearly expose some of the more leveraged households and firms, would also gradually increase the real cost of sovereign debt from current historically low levels. The global environment clearly has the potential to generate additional price shocks. And in spite of that, we're not entirely convinced that the era of low interest rates in advanced economies has come to a sudden end. There are structural factors behind low interest rates that are unlikely to change rapidly. And in the context of this particular recovery, as demand shifts from goods back toward services that have yet to recover to pre-pandemic levels, this may bring additional workers back into the labor force while helping to reduce excess demand for the scarce goods and commodities that are seeing the highest inflation. As a result of that, monetary tightening may not have to go very far to curb inflation in countries, particularly those with high household debt burdens, Canada being a good example of that, and those with relatively less affordable housing prices. We've concluded with just a chart showing the latest changes in housing prices over the last 2 years. Obviously, a number of countries have seen substantial run-ups, some of which already had elevated house prices. And there's certainly a potential for housing corrections. We think as economies rebalance and shift again more demand towards services and away from from housing and other household goods. We also would note some regulators are already tightening and preparing to mitigate against macroeconomic and financial stability risks. So we don't see this as a huge source of risk, but as another one of those factors we want to watch going forward to see how that affects the outlook. And again, the need for further monetary tightening in an attempt to contain inflation and get it back, keep it at levels commensurate with medium-term central bank targets. In short, and just to wrap up, the impending monetary tightening in and of itself is not a concern. It seems appropriate and necessary, provided that the world can successfully emerge from the pandemic. But the latest events, I think, are a very good reminder that there are risks all around us and a number of factors that may serve up higher inflation and other challenges in the months ahead. With that, we want to just remind you there are, you can enter questions into the chat. We're happy to address any questions you have and hope this has been informative for you. But we'll open up for questions. Nichola, with I'll handle this. There's a question just relating to the U.S. economic outlook and the strength of growth as we head into 2022. I would just emphasize, again, we're expecting growth to gradually slow. We're also expecting the year-over-year rate of inflation to gradually come down over coming months. But the questions we have are around, again, the very strong wage growth in the United States in real terms that could actually lead to continued strong growth, particularly if some of the built-up savings that were created during the pandemic are used for consumer spending in coming months. It's unclear how quickly that might occur, but when you look at even cash holdings and checking account balances in the US, they are at very high and unusually high levels for this stage of a recovery, and have grown significantly over the past 2 years in response to the government's stimulus support and those rising wages. So just important to note that demand may continue to run fairly strong in the US over the coming quarters, but we are nonetheless expecting it to slow.
Yeah, so Tom, shall I say a bit about the oil and gas vulnerability then? So if we have another look at the chart showing the oil and gas import dependencies, not the map, Tom, but yeah, the one with the country list. So I mean, it's very complicated to try to interpret potential impacts because there are multiple pipelines and rerouting and reverse flows and all sorts of things in Europe. But this chart, I guess, clearly shows that there are a couple of countries there where it's most likely that their gas supply flows through the geography of the Ukraine. So in particular, I'm thinking here about Slovakia, Hungary, and the Czech Republic. Because they are highly dependent on Russian gas as a source of energy too, it does kind of make them more vulnerable, but there are, I guess, many potentially mitigating factors related to their capacity and the possibility for rerouting gas through other pipelines. I mean, we're not pipeline security experts, so I don't have great answers on that. But yeah, it does pose a very serious risk for these countries, but also for other countries receiving energy through other pipelines that could become exposed to counter sanctions from Russia, disrupting the physical supply of gas. So yeah, just wanted to comment on that point raised. Okay, so Tom, also to wind up.
Yeah, again, maybe quick final call. If there are any additional questions, we're happy to answer those. But we thank everyone for your time, and we will feel free to reach out to our team if there are any follow-up questions.